What if the most important event in the global silver market did not begin in a trading room, did not begin in a mine, and did not begin on Wall Street, but began with a political statement about a frozen island most people cannot even locate on a map? What if a single tariff, quietly announced, did something decades of interest rates, algorithms, and price suppression never could? What if it didn't crash silver, but trapped it? What if right now, silver inside one country is becoming more valuable than silver outside it, and the global price you see on your screen no longer reflects reality? If the metal can't move, the price can't lie for long, and the moment the market opens, someone will discover they were hedged against nothing. Welcome to Boring Currency Ledger. If you are watching this with patience and attention, the way someone with experience listens before making decisions, then you already understand why this channel exists. So take a moment and subscribe. Not for excitement, but for clarity in a world that is becoming harder to understand. And tell us in the comments, from where in the world are you watching this unfold? The story did not begin in a trading room. It did not begin in a mine, a refinery, or a central bank meeting. It began with a political statement that most financial models were never designed to process. When the President of the United States announced a tariff tied to Greenland, the market reacted with confusion. Commentators treated it as theater. Headlines focused on diplomacy, not data. But behind the noise, a structural fault line in the global silver market quietly cracked open. The decision introduced a 10% tariff on imports from the United Kingdom, with a clear escalation path to 25% if political negotiations failed. On paper, it looked like a trade maneuver. In reality, it functioned as a logistical barrier, one that interfered with the physical movement of metal. This distinction mattered more than any press conference. The global silver market depends on the assumption that silver can move freely between major financial hubs. Traders, banks, and institutions do not price silver as a local commodity. They price it as a globally interchangeable asset. An ounce in one country is assumed to be equivalent to an ounce in another because transportation has historically been cheap, fast, and predictable. That assumption was never written into law. It existed only because the system allowed it to exist. The tariff changed that. By placing a tax on silver entering the United States from the United Kingdom, the policy introduced directional friction. Silver could still move out of the United States without penalty, but once it left, bringing it back became costly. The market was no longer symmetrical. Movement became one way. This mattered because London is not just another city in the silver trade. It is home to the London Bullion Market Association, the central clearing hub for physical silver in the Western financial system. New York, by contrast, dominates paper trading through futures contracts tied to vaults regulated under U.S. jurisdiction. For decades, the system worked because metal could flow between these centers. When one side ran low, the other could supply it. Prices stayed aligned because arbitrage enforced discipline. If silver became more expensive in one market, banks moved metal until the gap closed. The tariff interrupted this enforcement mechanism. No model priced this in because models do not account for political geography becoming a financial variable overnight. Interest rates, currency strength, and industrial demand are measurable. Border friction is not. Risk managers understood the implication immediately. If silver left the United States for London, bringing it back would trigger a tax that erased already thin margins. In a business where profit is measured in basis points, a 10% penalty is not a cost. It is a stop sign. This forced institutions to pause, then to reassess, then to halt movement entirely. The result was not a price crash. It was something more dangerous. It was a freeze. The silver market had always appeared deep and liquid because it relied on constant motion. Vaults in different countries were treated as extensions of one another. Ownership could be swapped on paper, with physical delivery assumed to be possible later. The tariff turned that assumption into a liability. Silver sitting in the United States now carried a different risk profile than silver sitting in London. Not because the metal changed, but because the rules governing its movement did. 2 ounces of identical silver began to diverge in value based solely on location. This was the moment when a political headline became a market event. The tariff did not destroy silver demand. It did not reduce industrial usage. It did not change mining output. What it destroyed was certainty, the foundation on which pricing depends. Without certainty, institutions retreat. Banks do not like unknowns. When they cannot model risk, they reduce exposure. They stop lending metal. They stop facilitating arbitrage. They stop smoothing volatility. What had been a single global market began to behave like multiple regional ones. The silver price people saw on screens still assumed a world that no longer existed. This was not a crisis of confidence. It was a crisis of movement. And in commodity markets, movement is everything. When silver cannot move freely, prices do not converge. When prices do not converge, hedges break. When hedges break, institutions pull back. And when institutions pull back, the paper market begins to drift away from physical reality. That drift had begun. The Greenland Tariff was not a financial weapon by design, but it functioned as one. It exposed how dependent the silver market was on political stability, open borders, and invisible trust. The event no model priced in had arrived, and the consequences were only starting to unfold. Markets do not fail all at once. They fail quietly, when a vital connection stops working and no one notices at first. For decades, the global silver market functioned like a living system. Metal moved through it the way blood moves through a body. When pressure built in one place, flow relieved it somewhere else. Prices stayed aligned not because of trust, but because movement made mispricing impossible. At the center of this circulation was a simple belief: silver could always be moved. This belief shaped everything. Banks built strategies around it. Traders relied on it. Hedging models assumed it. The system did not ask if metal could move, only when. That belief broke the moment tariffs entered the equation. To understand why, one must understand how silver is actually balanced across the world. The public sees a single price. Institutions see two very different machines operating together. One machine is paper-based. Futures contracts, leverage, and derivatives dominate it. The system is centered in New York, where trading volume is large and settlement is often financial rather than physical. The other machine is physical. It deals in real bars, storage, and delivery. This system is centered in London, anchored by the London Bullion Market Association. London is where large physical trades are settled and where metal flows onward to global buyers. These two systems stayed synchronized for one reason only: metal could move between them. When New York prices rose, metal could be flown to the US. When London ran short, metal could be shipped from the Americas. This movement enforced discipline. The tariff severed this artery. By taxing silver re-entering the United States from the United Kingdom, the policy turned a two-way corridor into a one-way exit. Silver could leave the US freely, but returning it became economically irrational. This changed institutional behavior overnight. Banks do not move metal emotionally. They move it mathematically. If a trade no longer closes profitably under worst-case assumptions, it does not happen. With tariffs in place, the worst case became unavoidable. If a bank shipped silver to London and later needed it back to settle obligations in New York, it would face a guaranteed loss. That loss did not depend on price movement. It was fixed at the border. As a result, movement stopped. This was not a coordinated decision. No announcement was made. No emergency meeting was held. Each institution reached the same conclusion independently: do not export what cannot safely return. This created what risk managers describe as trapped inventory. Silver sitting in U.S. vaults became effectively immobile, not by law, but by cost. The metal existed, but it could not serve its traditional role in stabilizing global prices. London felt this first. The physical market in London depends on inflows. It does not produce silver. It redistributes it. When flows slow, inventories fall quickly. London had already been under strain due to steady demand from Asia and limited new supply. The tariff removed London's last reliable pressure valve. What made the situation more dangerous was timing. The disconnection happened during a period of already tight inventories. There was no buffer, no excess stock waiting to absorb the shock. The result was not an immediate shortage. It was a loss of optionality. Banks could no longer assume that shortages could be fixed with logistics. They had to assume the opposite, that shortages would persist. This assumption changed pricing behavior. Arbitrage depends on confidence that differences can be closed. When that confidence disappears, price gaps are no longer invitations. They are warnings. Institutions stop stepping in. This is how a single market becomes two. Silver in New York began to reflect one reality. Silver in London began to reflect another. Both prices were correct. They were simply answering different questions. One answered, what is silver worth where supply is trapped but accessible? The other answered, what is silver worth where demand exists but supply cannot arrive? This is how circulation failure turns into price divergence. Importantly, this was not caused by panic or speculation. It was caused by rules. The tariff did not force banks to stop moving metal. It made movement irrational. In financial systems, irrational movement does not occur for long. What followed was a silent standoff. Metal stayed put. Paper continued to trade. And the link that once synchronized the two began to decay. This is how the silver market lost its circulation. And when circulation fails, pressure does not disappear. It builds. For a long time, the silver market appeared simple on the surface. There was one price, one number on screens across the world, one reference point used by miners, manufacturers, banks, and investors. But that simplicity was an illusion built on perfect coordination. The global silver price only worked because different markets were forced to agree. If prices drifted apart, institutions moved metal until the difference disappeared. This process was not optional, it was automatic. It was enforced by logistics. Once logistics stopped working, enforcement ended. This is where the true damage began. After the tariff disrupted physical movement, the silver market did not collapse. Instead, it fragmented. Fragmentation is more dangerous than panic because it spreads slowly and is harder to reverse. In a fragmented market, the same asset begins to carry different values depending on where it sits, not because of quality, but because of access. Silver in New York became silver that could settle contracts. Silver in London became silver that faced growing delivery risk. The price divergence that followed was not speculation. It was rational. Banks operate on hedges. A hedge assumes that losses in one place are offset by gains in another. This only works when prices move together. When they stop moving together, the hedge becomes exposure. This is called basis risk. Basis risk is feared more than outright losses because it cannot be predicted with precision. When institutions face basis risk, they do not double down. They withdraw. As price differences between regions widened, banks faced a choice: continue operating under assumptions that no longer held, or reduce activity to survive uncertainty. They chose survival. Liquidity began to thin, especially in paper markets. Futures contracts still traded, but fewer institutions were willing to take the other side, not because they lacked capital, but because they lacked confidence in delivery mechanics. This shift changed how prices behaved. In the past, high prices attracted metal. Now high prices simply signaled stress. If silver rose sharply in London, it no longer guaranteed relief through imports. The market learned that price increases did not fix shortages. They only revealed them. This reversed decades of conditioning. At the same time, the futures market in the United States continued to operate under the assumption of availability. Contracts referenced physical silver, but delivery relied on metal that was no longer moving freely across borders. This created a growing gap between financial price and physical value. To the screen, silver looked stable. To the supply chain, it looked fragile. Manufacturers began to notice. Industrial buyers do not care about charts. They care about reliability. When procurement teams sense uncertainty, they do not wait for confirmation. They secure supply early or reduce dependency. This behavior tightened physical markets further. The most dangerous aspect of this phase was that nothing appeared broken to casual observers. Trading continued. Headlines moved on. Volatility was intermittent. But under the surface, the market had lost its anchor. The idea of a single global spot price only works when metal can move to enforce it. Without movement, prices become local signals instead of global truths. This was the moment silver stopped being one market. It became a collection of regional realities loosely connected by contracts, not metal. For banks, this environment was unworkable. Their systems were designed for convergence, not divergence. They could manage volatility. They could not manage permanent dislocation, so they reduced exposure. Short positions were trimmed, inventory was hoarded, lending slowed. The paper supply that once suppressed volatility began to retreat. This is how fragmentation feeds on itself. Less arbitrage leads to wider spreads. Wider spreads increase risk. Higher risk reduces participation. The cycle tightens. Importantly, this did not mean silver became scarce everywhere. It meant scarcity became uneven. And uneven scarcity is what breaks global pricing. Some regions had metal they could not export. Other regions had demand they could not satisfy. The market no longer solved this problem. It displayed it. The old belief that silver is silver anywhere stopped being true in practice. From this point forward, location mattered as much as ownership. This marked the end of the global spot market as it had existed for decades. Not officially, not formally, but functionally. The screen still showed one price, but decision makers began acting on another reality. And once behavior changes, the price eventually follows. Every market crisis ends with a lesson. This one delivered several, and none of them were comfortable. By the time the silver market reached this stage, the damage was no longer theoretical. The system had revealed its weakness. What had once been treated as a single, global, efficient market was now clearly something else. It was a collection of regional markets held together by habit, not structure. The tariff did not create this reality. It exposed it. For years, silver had been priced as if borders did not matter. Contracts assumed smooth delivery. Risk models assumed mobility. Capital assumed neutrality. All of these assumptions were quietly invalidated. The most important change was not price movement. It was behavioral. Institutions stopped thinking globally and started thinking locally. Silver inside the United States was no longer just inventory. It became strategic material. It could be accessed, used, and delivered without political friction. That made it valuable in a way spreadsheets did not fully capture. Silver outside the United States became conditional. Its value depended on permissions, tariffs, and timing. This shift forced a reevaluation of what diversification actually meant. For decades, diversification was geographic. Assets were spread across jurisdictions to reduce risk. That logic assumed cooperation. It assumed that assets could always be retrieved or repositioned when needed. That assumption no longer held. In a world of tariffs and fragmented trade, geographic diversification can increase risk instead of reducing it. Assets trapped behind borders are diversified on paper, but immobilized in practice. This forced capital planners to rethink strategy. They began asking different questions. Not where is the best price, but where is the asset usable? Not how liquid is this market, but under what conditions does it stop functioning? These questions mattered more than forecasts. Another major shift followed quickly. Replacement cost overtook spot price as the relevant metric. Spot prices reflect transactions that happened in the past. Replacement cost reflects what it takes to secure supply in the present. When logistics are unreliable, replacement cost rises faster than spot price. Businesses that relied on silver, especially in manufacturing and technology, understood this instinctively. They did not wait for market confirmation. They moved to secure material before conditions worsened. This behavior reinforced scarcity. As more participants acted defensively, fewer were willing to release supply. Hoarding was not driven by fear, but by rational planning. If an asset may become harder to replace tomorrow, holding it today is logical. This dynamic pushed the market further away from equilibrium. For financial institutions, the implications were severe. Many strategies depended on confidence that price discrepancies would resolve. When that confidence vanished, leverage became dangerous. Exposure was reduced, positions were closed, activity slowed. This withdrawal removed artificial pressure from the market. The paper mechanisms that once dampened price signals lost influence. What remained was physical reality. The silver market entered a phase where logistics dictated value, where an ounce sat mattered more than how many contracts referenced it, where supply could be accessed mattered more than how much existed globally. This was not a temporary adjustment. It was a structural shift. The broader lesson extended beyond silver. The world was entering a phase of resource nationalism. Governments were prioritizing domestic availability over global efficiency. Trade was no longer optimized for cost alone, but for security. In this environment, capital that ignores geography becomes fragile. Markets that rely on frictionless movement become unstable. Assets that cannot move freely begin to trade at different values, even if they look identical. Silver was simply one of the first markets to reveal this clearly. For decision makers, the warning was unmistakable. Models built for a globalized world were no longer sufficient. Risk now included politics, borders, and logistics in ways that could not be hedged easily. The era of assuming continuity was over. Those who adapted early focused less on predictions and more on positioning. They prioritized access over abstraction. They valued certainty over optimization. They understood that in fragmented systems, resilience matters more than efficiency. The final lesson was simple but profound. Value is no longer just about what an asset is. It is about where it is, who controls it, and whether it can move when needed. The silver market did not break overnight. It revealed the future quietly. And those paying attention now understood something critical. The rules had changed, and ignoring that change would be far more costly than reacting to it.